Today we'll be talking about how to maintain your financial health in today's challenging economy. And we have three of our panel experts that will be speaking to you today. First up is Donald Cummings from Blue Haven Capital in Geneva. Donald has worked in both taxable and tax-free fixed income areas since the late 80s. His early market experience involved derivatives while on the floor of the Chicago Board Options Exchange. He's the principal co-founder of Blue Haven in Geneva, and it's an investment management firm providing low-cost money management to foundations, public charities, associations, and individuals worldwide. Don is here today to talk to you about bonds.
Can everyone hear me if I do not use the microphone? Yeah? Is that all right?
I can hear you.
Thank you for the invitation, Aziza. How many people think that a more complex portfolio is equivalent to a better performing portfolio? And maybe these days, after the last 6 months, most people would say no, complexity isn't good. But I have to say, in the old days, a lot of people did think that a complex portfolio was equivalent to a good portfolio. Can you not hear me? Is it better if I use a microphone? Okay. I'm here today to show you a less complex way of putting your portfolio together for a better return on your portfolio. And yes, that includes bonds. Bonds are a debt instrument. Bonds are a CD is a type of bond. You lend money to a bank. They promise to repay that money with interest. That CD, that bond, happens to be backed by the federal government. One could buy a bond from Coca-Cola, from McDonald's, from Walmart, from any number of firms. The other bonds that are out there in the market are not guaranteed, in most cases, by the federal government, but they're backed by the goodwill of the corporation, Coca-Cola, of McDonald's, of Walmart. Much like a CD, a corporate bond that you might buy has a certain maturity length, might be a 1-year, a 2-year, a 10-year instrument, and it has a certain rate of interest that it gives. There's been a new twist, a new bond that's come into the market lately, and that is a government-backed corporate bond. And these were created a few months ago really to increase liquidity in the marketplace. Corporations were saying, we're having an awfully hard time issuing debt to raise money to hire people or buy more machinery or expand our factory, and we need some help. So the federal government stepped in and said, we will back your corporate bonds. We will guarantee them, some of them, so go ahead and issue them. And those have become very popular, similar to CDs and very similar interest rates. The return that a person gets on a bond is more assured than the return a person gets on a stock. And because of that assurance, because of that likelihood of a certain rate of return, bonds tend to pay less interest, give less return than stocks. But in return for that, you have a usually less volatile instrument, a certain time period when that bond matures, and a certain interest rate. To show how much value that bonds can add to a portfolio, I'd like you to take a look at this sheet that Aziza was kind enough to hand out to everyone, with a quote from Warren Buffett at the top. And I'd like you to follow along and maybe write your answers in here as we go through this, and take a guess at some of these answers. The first question, the S&P 500 index. What has been the annualized return for the last 35 years, from 1973, including, I'm not excluding 2008, but including 2008? Any guesses, anybody?
than now, probably.
It's better now. Absolutely, it's better now. Yes, 8%. Somebody say 8? 8%, very close. The annualized return for the S&P 500 for the last 35 years is 9.2%. That includes last year's debacle. The S&P 500, by the way, is the 500 largest corporations in the United States, largest by capitalization. So what is a company worth?